first half of the year was eventful. Geopolitics drove volatility and headlines, while technology and AI set the market's direction. In this month's Market Compass, we'll look ahead to the second half of 2026 and see how those same forces, geopolitics, AI, and I will add the outlook for Fed policy, are likely to shape future outcomes. Here are 5 key views investors should consider for the second half of 2026. Renewed tensions in the Middle East are adding uncertainty, but we do not believe they will derail the economic expansion. While the boost from tax refunds is fading, a stable labor market and rising incomes, along with strong business investments and roughly $1 trillion in AI-related spending, are helping offset sticky inflation and elevated rates. We expect steady US GDP growth of around 2% in 2026. Inflation remains the fly in the ointment, having stayed above the Fed's target for more than 5 years. The second quarter pickup in price pressures was largely energy-driven and should gradually ease if the oil shock subsides. While geopolitical risks are hard to predict, it is encouraging that housing-related pressures are cooling. Wage growth, the largest cost component in services, is also less inflationary when adjusted for productivity gains. One of the biggest changes in the outlook this year has been interest rates. The narrative has moved towards higher for longer as inflation has reaccelerated. Under Chair Kevin Warsh, the Fed has reinforced its commitment to price stability. We expect the Fed to remain cautious, possibly consider further rate hikes, but ultimately stay on a prolonged hold, assuming oil does not return to the May's highs. Policy is now better calibrated, in our view, than it was during the tightening cycle of 2022. Many investors might be surprised to hear that valuations have declined this year and that earnings alone are doing the heavy lifting, driving market returns. S&P 500 profits are expected to grow more than 20% this year, led by technology, but also with broader participation across sectors. Solid economic growth, a manufacturing rebound after years of stagnation, and improving profit margins are all supporting broader leadership compared to last year when tech was the only game in town. We expect more leadership rotations in the second half, which will create new opportunities beyond the narrow set of winners who have been driving market performance. After gaining 88% in the second quarter, its best on record, the US Semiconductor Index has led the broader tech pullback in July. AI-related stocks have become more volatile as investors increasingly question both the pace and payoff of investments. We view AI as maturing, not breaking. Company updates are not yet signaling any slowdown in demand or spending, and we're likely still early in the adoption and dissemination of this technology. However, the next chapter in the markets will be less about riding the wave and more about monetization. In our view, investors should maintain exposure to AI allocations, but complement it with more diversified and differentiated sources of return. For cyclical exposure, we favor mid-caps, industrials, and international value-style investments. For AI exposure, we like communication services and emerging market equities, while we expect rotations both within and beyond tech. The second half of the year will likely bring more surprises, but as the first half showed, a disciplined and diversified approach can help investors capture broader opportunities across sectors and asset classes. For tailored guidance, connect with your financial advisor. Thank you for joining us for our July Market Compass, and we'll see you again next month with more market insights from Edward Jones.